So as Chief Investment Officers, you're looking at a world that seems to be talking about inflation, that looks to have this rotation trade back on, Marci. Are you sticking with it?
Yeah, absolutely. I think this is the big rotation now, and we've been expecting it since the strength of Q1 earnings season. The end of the day, I think you have a U.S. economy growing the fastest it has in decades, corporate profits surprising to the upside, and with the return of guidance, I actually think this could be another leg higher in earnings estimate revisions. And I think if you get yields drifting higher, but in a stable way, all of this for me is bullish for U.S. equities, both large cap and small cap.
Marci, we've seen this swing back and forth, though, over the past few weeks. People not necessarily leaving the market, but leaving tech, moving into cyclicals, moving back out of cyclicals and back into tech here. When you look at it from a sector basis here going forward, is this a situation where we're going to see all of the sectors participate meaningfully in the upside, or are there certain specific ones that you have your eye on?
Yeah, so we certainly like the cyclicals right now. I like financials on a yield curve steepening and on shareholder friendly activity. I think that's coming down the pike. I like energy on rising demand, and I think their cost cutting is going to give substantial operating leverage. But financials and energy are also going to do best in an inflationary or a rising inflation environment, I should say. Industrials on inventories rebuilding, I think that's a catalyst for these cyclicals. But I wouldn't abandon technology. You know, the digitization of the global economy, maybe it's the techization of all other industries. I think long-term corporate spending plans are still focused on tech. And if we're right and a CapEx turning point has happened and we're going to get more information on that in the coming quarters, I think that's another positive long term for tech. And then finally, healthcare, right? Every crisis reveals a crack. The COVID crisis revealed just the underinvestment in global healthcare infrastructure. So I would say it's cyclicals and innovation. But I think when the market rally resumes, it's going to be broad based.
What do you need to see then from the bond market? What cues are you taking at a 170 level?
Yeah, so I do think yields drift higher from here. I think it's the speed of the move now is what I'm watching. You know, I would say a year from now, you're going to have a 10-year certainly between 2 and 3%, because I think that will reflect the economic backdrop in the U.S. But I want to see it a drift higher, right? Not the spike that we saw in Q1. So as long as yields are stable and moving higher, I think the equity market's prepared for that. And again, I think that's going to be bullish on equities.
Marci, are you seeing froth in the market? Are you seeing froth pull back? We're looking again at meme stocks as we know them being pushed higher. We talk about various parts of the crypto market under attack. I'm interested in your perspective or whether your clients are asking you questions on this and worried about whether this is a good entry point.
Yeah, so I mean, sentiment, which is so difficult to time in terms of market corrections, is certainly improved off of the lows of last year and certainly over the last few months. So sentiment may be running a little bit hot. But at the end of the day, I think it's so important to take a big step back and look at the big picture. I think we are in a long-term secular bull market. The fundamentals are in line. And while we are certainly overdue for a correction, we haven't seen a 5% pullback since October. You could certainly get a correction here, but I would see that as a buying opportunity, because as long as the Fed's accommodative, and we think they stay that way, focused on the labor market, this is all bullish long-term for equities.